Hi everyone, Alex here with another quick video update. Today's update focuses on the federal budget announcements released this week. Now, before I get started, I just wanted to say thank you for all the wonderful messages following our 20th anniversary video update last week. They were very much appreciated. Now, moving on to the federal budget. There weren't too many surprises on budget night, with a number of the measures heavily speculated in the lead up. That said, some of the proposed tax changes are significant, arguably some of the biggest structural taxation changes we've seen in Australia for more than 25 years. Importantly, though, at this stage, these are proposals only. The measures still need to pass through Parliament and the Senate before becoming law. And as we've seen recently with other proposals, for example, Division 296 tax changes for superannuation balances above 3 mil, proposals can change quite materially between the announcement and legislation. So the key message up front is this: don't panic and don't rush to make major financial decisions purely based on budget headlines. In many cases, reacting too early can create unintended consequences, such as crystallizing capital gains unnecessarily, creating estate planning issues, or moving assets into structures that may ultimately prove less flexible over the long term. What's most important is taking time to understand the detail, assess the regulations when and if they are released, review options, and what changes may actually mean for you and your own circumstances before making or acting on anything. So, today I'm going to focus on the measures likely to be most relevant to many of our clients, that being changes to capital gains tax, changes to discretionary trusts, and less so, being negative gearing changes, the new 1000 instant tax deduction, and the working Australians tax offset. And there's also an extension to the small business instant asset write-off. So let's start with capital gains tax. From 1 July 2027, the government is proposing to remove the current 50% capital gains tax discount for individuals, trusts, and partnerships and replace it with an inflation indexation method. In simple terms, instead of automatically discounting half of a capital gain after holding an asset for more than 12 months, the cost base of the asset would instead be adjusted for inflation, and you'd be paying tax on the difference. On top of that, a minimum 30% tax rate is proposed to apply to net capital gains under the new system. Importantly, these changes would apply broadly across investments such as shares, managed funds, and investment properties. However, there are some notable exclusions. The family home remains exempt from capital gains tax. Superannuation funds are excluded and retain their current rules. Companies are excluded as they already didn't have access to the 50% capital gains tax discount. Existing small business capital gains tax concessions remain unchanged, and eligible new residential builds will be able to choose either the 50% capital gains tax discount method or the cost-based indexation, whatever gives them a better result. As mentioned, these changes will come into effect from 1 July 2027, but there is no reason to rush to sell good quality long-term assets before then. Any gains accrued before 1 July 2027 would still receive the existing 50% capital gains tax discount treatment. Only future gains from 1 July 2027 onward would move into the new system. For assets acquired before 20 September 1985, so pre-capital gains tax assets, the proposal would effectively remove their ongoing exempt status from 1 July 2027 onwards. Those assets would instead reset to the market value as at 1 July 2027, and future gains then taxed under the new rules. This means obtaining valuations for assets effective 1 July 2027 are likely to become very important. This will be easy for shares and managed funds, but potentially more cumbersome for property and privately held assets. So, what does this mean in practice? Firstly, this does not mean investors should rush and sell assets, good quality assets before 1 July 2027. Investment decisions still need to be primarily driven by the long-term quality and sustainability of the investment itself, not purely the tax outcome. While the proposed rules may reduce some of the tax advantages of long-term investing outside super, it doesn't automatically mean selling assets becomes the right strategy. What it may do, however, is change how investors think about the way that they sell assets and the way that those assets are held over time. For example, superannuation may become relatively more attractive as a long-term investment structure. It already was, but now even more so. Shares and managed funds may become more flexible than property in some cases, given they can be generally sold progressively over time rather than one big hit. Investment bonds and debt reduction strategies may receive more attention too. Now, we've been using investment bonds for many years for certain scenarios, and this may increase. Another important point is the proposed 30% minimum capital gains tax rate may reduce previous strategies of waiting until retirement or a low income year to sell large growth assets in order to access lower tax rates. Although again, the actual impact will depend heavily on individual circumstances and final legislation. Moving on to discretionary trusts. From 1 July 2028, the government is proposing a minimum 30% tax on discretionary trust income. Currently, discretionary trusts can distribute income across beneficiaries, allowing income to be taxed at the beneficiary's personal marginal tax rate. This can allow you to distribute income to beneficiaries with the lowest tax rate and change that distribution year on year to achieve the most optimal tax outcome. Under the proposal, the trustee would instead pay a minimum 30% tax upfront. Beneficiaries would receive a non-refundable tax credit for the tax already paid on their distribution. Any non-refundable aspect, the non-refundable aspect, sorry, is really important. So if a beneficiary's marginal tax rate is below 30%, they generally won't receive a refund for the excess tax paid by the trust. Corporate beneficiaries are treated even less favorably, with no credit available for tax already paid by the trust. The practical effect is that some traditional family trust income splitting strategies may become significantly less effective. There are also exclusions here: fixed trusts, superannuation funds, deceased estates, charitable trusts, and existing discretionary testamentary trust established before budget night are expected to remain exempt. Importantly, the government has also proposed a 3-year rollover relief period from 1 July 2027 for people wanting to restructure out of discretionary trust. So again, there's no need to rush. For some families, particularly those distributing income to beneficiaries on lower tax rates, these changes could materially alter the effectiveness of the structure. But for others already paying tax above 30% and unlikely to be below that for the future, the practical impact may be more limited. And of course, trusts are often used for other reasons beyond tax alone, including asset protection, control, estate planning flexibility. So these factors still remain important. This is a significant change that we'll be watching closely. Now, briefly on negative gearing from 1 July 2027, negative gearing deductions on established residential investment properties acquired after budget night will no longer be able to offset other income such as wages. Instead, those losses would generally be quarantined and carried forward to offset future property income or potentially reduce future capital gains tax. Importantly, existing properties held before budget night are grandfathered. Eligible new builds remain exempt from the changes, and these rules don't apply to shares and commercial property. This may reduce the attractiveness of some highly leveraged property strategies, particularly where the investment relies heavily on the tax deductions rather than the underlying investment fundamentals. The budget also included a couple of smaller measures. From 1 July 2026, taxpayers earning work income will be able to claim a standard $1,000 instant tax deduction instead of itemizing work-related expenses. Now, if your deductions are higher than $1,000, you can still claim the actual expense in the normal way, but records will still need to be kept. From 1 July 2027, a new working Australians tax offset of up to $250 per year will also apply for eligible individuals with work-related income. It's designed to reduce tax payable on employment or sole trader income and will be applied automatically through the tax return process. And finally, small business owners. The $20,000 instant asset write-off is proposed to become a permanent measure from 1 July 2026 for eligible businesses with turnover under $10 million. So, in summary, these are significant proposed tax changes, particularly around capital gains tax and discretionary trusts. I can imagine many of you will naturally have questions about what this could mean for you personally, but the key takeaway is not to overreact to policy announcements before legislation is finalised. There's plenty of time to properly assess the detail, understand the transitional rules, and consider any changes carefully and strategically. Tax rules will continue to evolve over our lifetime. That's simply a part of investing and long-term wealth creation. Our role is to help you maintain perspective, to understand which changes are genuinely relevant to your circumstances, and to make thoughtful decisions aligned with your long-term goals. As always, we'll continue monitoring developments closely and we'll discuss any of the relevant implications for your personal circumstances during your upcoming review meetings. Thanks again for watching and we'll speak soon.